Hey, this is Mark from Gallagher Home Loans. It is actually the 18th, Saturday the 18th. I'm doing a wrap-up for last week, the week ending April 17th on the markets, and then we're going to talk a little bit about program changes and what a lot of lenders are looking to do and are already moving towards. So let's take a look at the markets real quick. So what you're looking at is Friday's graph. It looks worse than it is as far as the up and down movement. The price differential between the high and the low really wasn't that great. Again, we talked about this last week. The only buyers really that are in the market is the Fed. So the Feds are buying bonds $5, $6, $7 billion a day, spread out over different coupons. There's a 2.5% coupon, 3% coupon, 3.5% coupon. Most lenders are following the 2.5 or 3% coupon. So basically, without anybody else in the market, the Fed is just trying to keep rates steady. So on the 2.5% coupon, the actual rate that the bondholder is getting is less because the price is above 100. So anytime the price goes above par, it drives down the yield. So the yield is actually less than 2.5%, which is why nobody else besides the Fed is really interested in buying bonds right now. So let's go ahead and take a look at the past week. So again, there seems to be, so this is indicative of how much money the bond is putting in. So on Monday, the market opened off of its highs from Friday. So the price dropped. There was some buying in here and kind of cratered out on Tuesday. And then the Fed was back in buying bonds. So again, but the price differential isn't that great, so it looks worse than it is as far as volatility. Rates did go up a little bit over the course of the week. There was some upward pressure to pricing. So let's take a look at I think it's about the last 4 weeks. Once we go out to the last 4 weeks, you can see that it's pretty consistent. I mean, the Fed's done a good job keeping the price fairly consistent, so the yield is fairly consistent. But again, this just isn't translating into lower rates for most lenders, because if you're a servicer and you service your own loans, when somebody goes into forbearance and they stop making that payment, the servicer still has to mail that check out every month and still has to pay the taxes and the homeowner's insurance when they come due. So there's all this money going out and there's not that much money coming in. And we're still waiting for the federal government to step up and add liquidity for the servicers to get us through this. So basically, they're raising rates, or they're keeping rates a little bit higher so they can make more per deal to try to get some of the cash back. Makes perfect sense. We are afraid that if the Fed doesn't step in, that some of the smaller servicers may be out of business before this is all said and done. The Fed says that if the servicers, if they look like they're going to default, then they're going to move their servicing all those loans to a bank. So so this is like 2007, 2008, or it sounds like it, like they're going to force the banks to buy servicing that doesn't perform. I don't really know how that's going to work and why a bank would actually want to do that. So again, this is the last 4 weeks, and you can see that this has been fairly consistent. So let's talk a little bit about programs and matrices and requirements. So let's start with FHAs. A lot of lenders were taking FHA loans as low as 580. A couple of them went all the way down to 500. Almost everybody that I've talked to is at least 620, if not higher than that. We've raised ours from 580 to 620. Not to mention that the debt to income ratios are getting tighter, so your ratios can't be quite as high as they used to be. And if the ratios are high, and depending on the situation, we may actually want to look at 6 months to up to 6 months reserves. So if we increase the reserve requirements, that means a lot of people don't have a lot of money sitting in the bank or don't have investment accounts. They may have to wait until things loosen up a bit. So that's the deal with the government bonds. VA doesn't seem to be they haven't changed too many of their requirements, although the same type of deal. We were at 580, now we're at 620. Most lenders are raising their minimum credit scores, along with rural development also. So that's something to watch out for. So on the conventional side, I've heard all kinds of stories where some lenders are actually raising their minimum credit score to 700. So the minimum credit score from Fannie and Freddie from the agency is 620. But again, because of uneasiness about people having jobs and future jobs and all of that, it's starting to affect the underwriting guidelines. So most lenders are starting to raise their requirements. We have not changed our FICO requirements, so we're still taking loans at 620. But we're going to be really diligent in looking at the debt-to-income ratio and how much they have in reserves once they've closed. So again, this is going to be lender by lender, and then it's just going to depend on how much risk that lender wants to take in this environment. So if there are people out there that are pre-approved with a lender, they need to call the lender and they need to say, okay, based on the current rules, am I still pre-approved? Do I still fit the requirements? And if not, they need to start making adjustments. So let's talk about bond programs. MSHDA is a bond program. Bond programs are state-run programs where these are typically down payment assistance programs, and they change from state to state. The problem with bond programs is that once we close a MSHDA loan, and the servicer, which is U.S. Bank, buys that loan from us, even if the borrower defaults or goes into forbearance 2, 3, 4 months down the road, we're required to buy that loan back. So that's a problem, and that's a problem with all lenders. So a lot of even the big lenders, Loan Depot has shut it down. Caliber, as of today, has stopped writing bond programs. I mean, I'll still do pre-approvals on MSHDAs all day long, but we're just not able to use them quite yet. I have been in contact with MSHDA to see if they're going to change the rules a little bit and lighten up a little bit, but I haven't heard back yet. But this is a problem. This is a liquidity issue. You know, if someone closes a loan and a month and a half later it goes into forbearance and we have to eat that loan, we basically have to write a check and get the loan back. If we do that enough times, it causes issues with our liquidity. So lenders just aren't willing to do that. So you're going to see there's some constriction in the MSHDA program. But as always, if you've got any questions or your borrowers have any questions, or anybody, even if there was somebody else right now, they just want to ask a question, I'm more than happy to talk to anybody. Give me a buzz, 248-705-8431. We're still closing purchases in under 30 days. And, we're open for business. We've got a lot of refis, but purchases always come first. So give me a shout and let me know what I can help you with. Have a great day.